Gennadiy Goldberg of TD Securities writing, "We believe the long end has been subjected to death by 1,000 cuts." Gennadiy joins us now for more. Good morning, good to see you.
Good to see you.
Everyone's always looking for that one simple explanation for something, but I'm struggling to do that with this bond market. Are you?
Yeah, I mean, I think everybody likes to have their pet explanation. I've heard, one of the reasons we wrote the note was everyone's reached out with, do you think it's this or do you think it's that?
Confirming the price.
Right, and really it's everything. It's a little bit of supply side, a little bit of demand side, and a little bit, as Mark said earlier, it's a little bit of this, what's the Fed's reaction function? We just simply don't know.
So how easy is it to fix, given it's been death by 1,000 cuts?
I think you can still turn the ship around. I don't think it's a lost cause by any means. I don't think things are so bad that they're unfixable. Chair Warsh gets another chance at bat next week. Let's see if he makes anything of that. I think the bond market sort of read him Miranda to some extent. I mean, if you think about it, they've basically said, we need, if you do not give us your reaction function, one will be assigned to you. And the one they're assigning to him is not the one that the Fed necessarily wants to be assigned.
Is there a tactical opportunity to get long into Jackson Hole?
I'm a little bit nervous in the very short term. The amount of conviction I hear among investors is just rock bottom. I mean, I feel like that's been the case basically for the last year. It has just been really, really low right now. And it's because of this combination of factors. It's supply side, it's demand side, it's the Fed. So yes, the Fed can start to right the ship, but you also need the Treasury to start to play ball. And they've sort of started to kind of talk about maybe reducing long and auction sizes. But it's this global rise in rates that's really got everybody worried. So the worry isn't the next 12 or 24 months. Everybody knows that yields will do just fine over that horizon. The worry is the next 3 to 6 months. Maybe I get in at 470 on 10s, but perhaps they'll go to 5%, and I've actually missed the boat.
But the question is, the Financial Times gave the appetizer for how he actually feels. Don't you think in Jackson Hole he basically needs to socialize this and communicate this in a speech?
I think that's the assumption. The problem is we don't know. I mean, look, he could come out and just tell us nothing once again. And do we know that the FT was sourced from people who are actually close to the plan? I think that was an attempt to damage control, but we'll see if he does it again. I mean, so far, he's not given us all that much to chew on.
Who do you think is whining? And I don't mean to be like cute here. Is it the bond market that's whining, or is it actually the Fed saying you've got addicted to this forward guidance? The bond market's like, we're actually not asking forward guidance. We just need to understand your reactionary function.
I think the bond market isn't whining. I think the bond market's speaking. And when the bond market speaks, people listen, because it does tend to send, shockwaves through the system. We don't know where the instability lies. One of the things I was discussing just yesterday, everybody's worried about this move higher. Why isn't volatility higher? Well, it's been a slow bleed. And the longer this goes, the more likely this is to create some volatility in the system. And we don't know where the shockwaves will actually end up.
You mentioned the reaction function. I think there is a sense of an understanding of the committee's reaction function, given the way we rallied at the front end following weaker than expected data over the last 2 weeks. 2-year yields came in because people believe that'll keep their Fed on the sidelines. That's not uncertainty. What's curious to me is whether there are market participants who believe because they're going to sit this out, that's a problem. And I think that's a different kind of question.
I think so. To their point, I think a lot of the FOMC members in that core, the middle, so your Wallers, your Williams, the folks who are kind of teetering on maybe we should hike rates, maybe we shouldn't, have kind of hinted that their bar for hiking rates is actually a lot lower. Now, it's a little bit tricky when you don't have the data you need to kind of justify your move. But if that's the case, then the market will be a little bit more, I would say, kind of heartened by that. Now, if over the next couple of months the data just kind of continues to come in middling, we get core PCEs at 0.22s, 0.23s, the labor market stays pretty firm, that could continue to weigh on the long end. And I think that's the danger here, is that we're still sitting it out. The market's going to assume the Fed just kind of keeps coasting. And I think that's the danger here. So the question is, why not get ahead of it and actually hike rates? But they kind of need an excuse.
So you think hikes would help the long end?
I think so. I think the curve would flatten materially on a rate hiking cycle. It's not going to be one hike. It never was. If they do hike, and it's not our base case at TD, but if they do hike, it's going to be at 50 to 75 basis points.
What's your base case?
Our base case is a hold. We think they actually try their best to hold through it. Obviously, the risk case is by September, by October, that you actually get enough to hike rates.
So if you're at a hold, that takes care of the front end of the curve. Where's the long end going out to?
I think we hover around here. I don't think we break out to 5%. I think 5% is a good line in the sand. Okay. I think there's enough investors who are keen to pick up 5%, both in real and nominal terms, by the way. Real rates are actually quite attractive as well.
If they hold in September, and I know you're a base case hold for the whole year, but if they hold in September, there's no way they would be able to hike in October. Do you think politically?
I think they can. I think if you start to get 0.3s, 0.4s on inflation.
Before midterm election, days before?
They've done it before. They cut into the last election. So at the end of the day, they're going to, it's not something that really enters their thinking as they're trying to do things.
Can they hike before the task forces give us, their prognosis of what's going on at the Fed?
I think so. I mean, I'll put it to you this way. I think we're actually very, very close to a September hike. Even though it's not our base case,
okay.
I think the bar is actually incredibly low.
What do we need? We've got one more payrolls print, one more CPI print. What tips us over the edge?
We get a 4%, unemployment rate for good reasons, not for bad reasons. We get 150 to 200K payroll, and we get a 0.35 to a 0.4 on core PCE. I think that core of the committee, your Williams, your Wallers, your Cooks, your Jeffersons, are really going to consider it. And we know 3 of them already want to hike. They dissented. You don't need that many more people to basically overrule the Fed chair.